Hi, welcome to an overview of financial analysis. Financial analysis helps us answer the question of how is our company doing? It's important material that you'll be using for the rest of your time here at ISU and in other classes and on the job, and if you choose to invest in stocks. One of the questions that management researchers are interested in is, why do some firms perform better than others? And if we're analyzing our own company, how can we help our firm perform better? And financial analysis has a role to play in that. So let's look at scenario one. Which firm is performing better? We have two pieces of information. Firm A has revenues of 100 million and firm B has revenues of 300 million. Which would you rather invest in? We really can't tell. If we're only looking at sales as a performance measure, then we would say firm B. But if we're looking at profit, remember the profit equation, revenues minus expenses equals profit, right? All we can say is that firm B has more revenues than firm A. But in terms of performance, we really can't tell. So let's look at scenario two. Firm A has profits of minus 10 million. Firm B has profits of 20 million. Even though we still have limited information, at least we can generally speaking say, yes, it's better to make money than to lose money. So saying that firm B is performing better than firm A is probably a good call. Scenario three, in which firm A has positive profits of 10 million and firm B has profits of 20 million, well, now it's not so clear. Right? So hopefully you're saying, I need more information. Right? Firm B could be 5 times as large as firm A, but is only making twice as much. So that additional information can help us compare the firms. So scenario 4, we get some additional information. So we still have firm A making profits of 10 million, firm B 20 million, but now we know the assets that they're using to make that profit. And so we can see that in terms of profit, firm B is making more. But if we look at the return on the assets that we're using, 10 divided by 100, firm A is making a 10% return on assets, and firm B, 20 million of net income using 400 is only making a 5% return on investment. So think about this in terms of your savings account, right? Which would you rather have, a 5% return or a 10% return? In this instance, and again, the information is still limited, but firm B is a stronger performer. Oh, sorry. Firm A is a stronger performer. So, financial management allows us to answer the following types of questions. How are we doing? Are we making or losing money? How profitable are we? How much cash do we have on hand? Do we have enough cash to pay our bills? How efficiently are we utilizing our assets? How do we compare to others that are in our industry, our competitors? If we want to expand, where are we going to find the funds, and will we be able to acquire those funds? And then finally, are we overall financially healthy? So, looking at the financial reports that we have available to us and using some ratios to do some comparisons or to do some time series analysis, we can look at 4 major types of ratios. Profitability, which measures the company's ability to make a profit. Liquidity, that measures the company's ability to meet short-term obligations, right? To meet our bills every month. Efficiency, how productively we're utilizing our assets. And stability, are we going to go bankrupt soon? How healthy is our financial structure? And so in that situation, we'll look at our level of debt. This is why those financial statements are so important, because by analyzing the information in them, we can assess if we're doing what we want to be doing, if we're achieving the type of performance that we want. Additionally, our financial statements give us a foundation on which to make estimates of our firm's future income, the future expenses, and enable us to visualize concretely how we're going to achieve our future plans. So this would be something that we would use to attract investors to obtain a loan. So not only our historical financial statements, but the forecasts that we make based on them are important to the success of our firm. The process is by adding financial ratios to our historical income statement, balance sheet, and statements of cash flow. Right? Financial ratios depict the relationship between items on these statements relative to an income statement and a balance sheet. And an analysis helps determine how we're doing. The 3 main categories that we'll be focusing on are the profitability ratios, answering the question, how profitable are we? Our leverage to debt ratios, our leverage or debt ratios, as they're commonly called, which is basically what is our financial structure between money that our firm has borrowed and money that investors have put into our firm. And then finally, liquidity ratios, which are going to give us insight into our ability to meet our monthly or quarterly financial obligations. So these three categories are important. The reason that we have more than one ratio in each category is because they each give us a slightly different perspective on our performance. The net profit margin, which is also known as return on sales, is calculated by net income divided by total sales or total revenues. It gives us a sense of what is the percentage of profit that we're making on each dollar of sales. Return on assets, also a productivity ratio. It gives us the sense of how many dollars, what percentage of a dollar are we making for each dollar that we have on assets. And return on equity, and I have to apologize, I just saw an error here. This should be total equity, is for every dollar in equity that we have, what's our return, right? Net income divided by total equity. Apologies for that typo. Our leverage ratios, although there are several others mentioned in your text, but remember, we're not an analysis of financial statements class, and so we're going to concentrate on a few of the most common ratios. Long-term debt to equity ratio, that gives you an idea of how much of the firm is financed by equity and how much by debt. And then if you think about it, if you relate it back to a mortgage on your house, right? How much equity do you have in the house? That's the amount that you've already paid and that's what you own versus your long-term debt, how much you still have to pay. The next ratio is the long-term debt to assets ratio. And that gives you the sense of a more total picture. It's all of your liabilities, not just your long-term debt, but your current liabilities, everything that you owe versus your assets. And so if you think about this one, whereas profitability ratios, the higher the better, right? These ratios, if we're interested in borrowing more money, we would like these to be lower. Right? And in some industries, the norm would be higher. In industries such as airline industries, it's not uncommon to have a long-term debt to equity of 3, which means you have $3 of debt for every dollar of shareholder investment. However, generally we get a little nervous, and when I think about the airlines that have had debt to equity ratios over 3, they don't exist anymore. They went bankrupt. Our liquidity ratios, this is basically the idea that you can pay your bills every month, right? So again, going back to the mortgage analogy, yes, I bought a house for $200,000. My mortgage is $1,200 every month. This is assessing, can I pay that $1,200 every month? Not, can I pay off my mortgage of $200,000? Right? Just can I make my monthly payment? So the current ratio looks at, from the balance sheet, our current assets, which is cash and cash-like, right? Do we have money in CDs or long-term funds? Do we have people that owe us money this month? Versus current liabilities. Who do we have to pay, right? We have to pay rent on our lease for our factory. We have to pay our raw material suppliers, etc. And so this is important because we need to continue moving the business forward. The quick ratio is a little bit tougher, and typically you can only use this for manufacturing firms because it's taking your current assets and subtracting the inventory and then dividing it over current liabilities. So we're a manufacturing company and we have so much in cash and so much in short-term investments, and we have inventory, products that we've already produced but haven't sold yet. And then we divide that over current liabilities. In most industries, they like the current ratio. Kind of the rule of thumb is the current ratio should be around 2. But in certain industries, particularly large retailers like Walmart, if you look at their current ratio is less than 1. And you're just like, how can they get away with that? They can't pay their bills. Well, Walmart is such a powerful company to be doing business with. They can probably delay paying their bills to some smaller companies that they owe money to, right? And they're powerful enough that people are going to pay what they owe to Walmart on time. And so that allows them to have a current ratio less than 1. But this is one ratio where you really don't want it to be too high, right? That's why the rule of thumb is 2. If your current ratio is 10, that means you have too much money in cash and you're not utilizing those resources to grow your firm. So a too high current ratio can also be a negative. Thank you for listening, watching. I'm sorry this was a little longer than I intended, but I hope it's given you the basics.